Have you ever wondered if the safe haven of gold was actually a 30-year trap engineered to protect the US dollar? Welcome back, millionaire investor. Did you know that the US government spent decades keeping gold prices artificially low, using massive interest rate hikes and currency swaps to fool investors into believing the dollar was the only safe bet? If you bought gold at its 1980 peak, you were the victim of a global suppression that forced you to wait nearly 3 decades just to see your investment return to zero, all while the Federal Reserve printed trillions to maintain the illusion of dollar dominance. But was that a market reality, or a decades-long scheme to devalue your savings while trapping you in paper assets? While Western investors were successfully fooled into holding dead money in New York, why were families in Turkey, Egypt, and India ignoring the US charts and watching their wealth multiply 10 times over in that same window? If you look at the raw global data, gold in US dollars hit a massive dead zone between 1980 and 2007, leaving many Western investors underwater for decades. But for the rest of the world, the story was one of consistent multiplication as weakening local currencies turbocharged returns in local terms. Because gold is priced in dollars globally, every drop in your local currency makes your gold more valuable at home. While a New York investor was just finally breaking even in 2007, international holders had already seen their wealth multiply several times over. Looking back to 1971, 1980, 1991, 2007, 2015, and now 2026, gold hasn't just grown, it has effectively preserved 3 generations of labor against the slow erosion of global currencies. Gold operates in 2 distinct but related financial worlds. The first is the global market, where its price is predominantly quoted in United States dollars. This is the price you see on financial news networks and trading platforms. It is influenced by the strength of the dollar, interest rates set by the Federal Reserve, geopolitical tensions, large institutional investors, hedge funds, and central banks. When analysts on Wall Street discuss gold, this is the one global benchmark they mean. The second world is local, and here gold acts as a powerful shield. In countries with high inflation or currency instability, gold is less an investment and more a form of savings. It protects the value of labor and accumulated wealth. When a local currency weakens against the US dollar, the local price of gold rises automatically, even if the dollar price stays flat. Let me give you a simple example. Gold is approximately $5,000 per ounce. $1 is roughly 43 Turkish liras. A single gram of gold now costs over 7,000 Turkish liras. Even if the lira slides further to 50 per dollar, as long as global gold prices stay flat, your local wealth continues to climb. After hitting a spectacular peak around $850 per ounce in January of 1980, driven by high inflation and geopolitical fear, the price entered a multi-decade dead zone. For a dollar-based investor, it was deeply frustrating. It bottomed below 300 in the late 1990s. Opportunity cost mounted as U.S. equities delivered incredible returns. Why own a non-yielding lump of metal when tech stocks were booming? The dollar was strong and inflation seemed under control. Gold's hedge and haven roles looked obsolete, cementing negative bias on Wall Street. Meanwhile, many countries faced crises, hyperinflation, and dramatic devaluations. For families in Brazil and savers in India watching the rupee slide, gold preserved wealth while paper money withered. What looked like a U.S. dead zone was a local bull market, proving performance depends on the currency you measure it in. August 1971. Nixon severed the final link between the US dollar and gold, ending Bretton Woods. Gold was set free from a $35 peg to trade openly. Price discovery erupted amid oil shocks and soaring inflation, culminating in the 1980 peak. Aggressive policy tamed inflation, and gold fell into a long decline. After 2000, the dot-com bust, the 9/11 shock, and a weaker dollar reset the stage. The global financial crisis drove gold to new highs by 2011. A quieter 2015 saw a stronger dollar, even as gold still worked in many other currencies. Today, prices sit at new highs for more structural reasons: unprecedented sovereign debt, central banks shifting away from dollar reserves, and growing distrust in the weaponization of financial assets. Gold's role evolves with the architecture of the system, from gold standard to fiat dominance to a more multipolar world. We've entered a new era where gold is again proving itself globally and locally. The traditional tool of raising rates to support the dollar has become dangerous in a high-debt world. Every percentage point adds enormous interest expense, constraining policy and making gold more attractive. Central banks across East and emerging markets are consistent large-scale buyers, a strategic long-term diversification away from dollar risk. Recent freezes of foreign reserves broadcast a lesson. Paper claims carry counterparty risk. Physical gold in your own vault does not. Gold can't be sanctioned, frozen, or devalued by another country's policy. More trade is settling outside the dollar. The dollar won't vanish, but gradual erosion reduces demand for dollar assets. In a multipolar world, a stateless monetary asset gains stature, turning cyclical demand into something more foundational. These structural forces create a persistent tailwind for gold. As of early 2026, two warning signals are flashing. First, RSI divergence. In a healthy trend, new price highs should be matched by new RSI highs. Today, they aren't. Weekly and monthly RSI have posted lower highs, signaling waning momentum. It's like the engine quieting while the speedo reads higher, a likely pause ahead. Divergence often precedes consolidation or a correction. Second is psychological. When barbers, cab drivers, and distant relatives pitch gold with fear of missing out, enthusiasm's gone mainstream. That's often the final stage of a speculative rally. It signals buyer exhaustion, with less new money to push prices higher. Combined with RSI divergence, the risk of a short to medium-term pullback is elevated. Prudent investors take note. Gold doesn't pay yield. In long plateaus, your capital feels stuck, and other assets may run. That's the opportunity cost. But plateaus often set up the next bull leg as markets revert to the mean. The 2026 Nillionaire Master Strategy treats gold as a core pillar. In today's market, your greatest enemy is illiquidity. We've seen financial institutions paralyzed when stocks and bonds crash simultaneously, leaving them with no clean assets to sell. To avoid this trap, growth investors should maintain a 10% floor in gold to provide dry powder when markets freeze. If you want a balanced, all-weather portfolio, 15% to 20% is the sweet spot to offset volatility. But for those hedging against a systemic great reset, an asymmetric bet of 25% to 35% turns gold into your primary engine, shielding you from the collapse of paper assets. Basically, replace your bond or fixed investment allocations with gold in your portfolio. Ultimately, if you're buying for legacy over the course of decades, entry matters less. Gold has tended to outpace the cost of living over long spans, your family's private central bank. Hard work beats talent when talent doesn't work hard. At these 2026 levels, don't buy all at once. Pace your purchases and wait for the red days to build your position. Do you want to know how much of gold I hold in my portfolio? Leave a comment below. Stay savvy and happy investing.